Let's talk about variable costing. In Chapter 19, we're really going to get to this place where we have to start thinking about two different ways that we're going to deal with the information that we're provided. Um, and let's just talk for a second about absorption costing. We'll get to the variable costing in a second. And the reason the chapter is called variable costing, even though we're comparing this, is because you already know what absorption costing is. You just haven't heard it called this yet. It's what you've already been doing. When you think about products, let's just remember this for a second. When you start to classify cost um, by their function, it's either going to be a product cost or a period cost. We've determined that. And we know what product costs are. It's everything that happens in the factory, and they can be further defined as direct material, direct labor, and factory overhead. That's what product costs are. And under absorption costing, as you can see here, it assumes that all products absorb all cost incurred to produce them. Well, that's exactly what we've been doing. We've been putting all of the direct material per unit into each product, direct labor per unit into each product, and we've been applying the factory overhead to each product. And the factory overhead is all that stuff, the rent and the depreciation. Remember, we had to have that predetermined overhead rate. We've been pushing all of that cost into the product, and that's what absorption costing does, called full costing. You'll see here that it says it's widely used for financial reporting or generally accepted accounting principles, and that's really because for tax purposes it needs to be that way. Not only that, but for pricing your product, it needs to be that way. If you're going to price your product out, if you want to figure out how much to sell a product for, then you want all of those costs inside of that product, right? You've got to be able to price it appropriately under absorption costing. Okay, so now that we get that, what's this variable costing stuff about? Well, variable costing only looks at the change in total with changes in production. That means that we're only going to deal with the variable cost, and we kind of know what those are, right? Direct material and direct labor is what we've only ever defined as variable at this point. But there are some other variable things that we can bring over. But why do we do this? Why are we going to do this under variable costing? And it's all about evaluation. It's about a better way to be able to evaluate what's going on inside your factory. The reason is because you really can't control the overhead at all. So here's, we're going to look at the difference between absorption and variable costing, and you'll see here that under absorption costing, all of it, there's everything we talked about, and you'll see now that we've split overhead into two components. No longer is it just overhead, but now it's variable overhead and fixed overhead. These are always variable, no matter what. But under absorption costing, in product cost is direct material, direct labor, and all overhead. Let's look at variable costing. In variable costing, only direct material, direct labor, and the variable overhead piece are going to be a part of product cost. The fixed overhead piece is now going to be considered a period cost. We are not going to apply the fixed overhead piece into the cost of our product. All right, so here's again the difference between the two here. The summary of cost product data, we're going to use this throughout. If direct material is $4 per unit, direct labor is $8 per unit, and then in overhead we have a variable piece and a fixed piece. 180,000 variable, 600,000 is fixed, and we expect to produce 60,000 units in this product line. So our total overhead cost 780,000. Before under absorption costing, we would take this times 60,000, we would take the 8 times 60,000, and then we would add in all 780,000 in order to figure out what our product cost was. All right, so here again, we can see that variable piece now is $3 per unit. Right? If we take the 180 divided by 60,000, that's $3 per unit. So here's where the difference lies. Under absorption costing, we're going to consider the fixed overhead. How did we get to this $10? Well, you probably guessed it. We took 600,000 divided by 60,000 units. So under absorption costing, our product cost per unit is 25, But under variable costing, if we take out that period piece, the piece that we're now saying is a period cost, we take it away. Under variable costing, our product cost per unit is 15. That's dramatically different. All right. So the analysis of income reporting under these, so if we, again, we're taking a look at this. So direct material 4, direct labor 8, variable now 3, and fixed overhead costs is 600,000. And then they're going to say, hey, well, wait a minute, we've also got some other variable expenses of $2 per unit, probably commissions or something like that. And then fixed expenses are going to be 200,000 per year. So let's see what happens when we use this data. In 2013, we're saying that we produced 60,000 units and we sold all 60,000 units. Therefore, there was nothing in ending inventory. That's understandable. In 2014, we produced another 60,000 units, but we only sold 40,000 units, and that left us 20,000 in our ending inventory. In 2015, we produced another 60,000 units and we sold all 80,000 units in inventory. Where did that come from? The 20 that we started with plus the 60 that we produced gave us 80,000 available for sale, and once we sold them, we had nothing left in our ending inventory. So let's look at income statement using absorption and then using variable. So here we go. We're talking about Ice Age using that very same data. This is the income statement under absorption costing. This is the way we've been doing it all along. It's for the year ended December 31, 2013. 2013 is the year that we produced 60 and we sold 60. Okay, so sales at 2.4 million, cost of goods sold at 1.5 million. How do we find that? We know that we're selling them for $40 a piece, and we know that our full absorption costing was $25 a piece. I'm going to back up just a couple slides and show you that. It's right here, $25 a piece under absorption costing, right? Once we move to variable, you'll see cost of goods sold will switch to 15. Let me move back forward again. There we go. So that gave us a gross margin of $900,000, gross profit, whichever way you want to look at it. Then we take out our selling and administrative expenses. They gave us data on that. It was fixed admin expenses of $200,000, selling expenses of $2 a unit, so $320,000. We have a net income of $580,000. Okay, that's under absorption costing. Again, we produced exactly what we sold. And what I'm going to tell you right now ahead of time is that under variable costing, we should also get $580,000. At any point that you produce exactly what you sell, absorption costing and variable costing is going to have absolutely no difference. So here it is under variable costing. Again, we sold 60,000 units, 2.4. And we had 60,000 units now at $15 a unit, not 25, it's 900,000. We bring in our variable selling and administrative expenses of $2 a piece for 120,000. And notice now that we call this a contribution margin. We understand at this point, right? We understand at this point that when you take sales minus variable expenses, you get contribution margin. That's the proper terminology. Sales minus cost of goods sold is gross profit or gross margin. Sales minus variable cost is contribution margin. Contribution margin here is 1.38 million. We take away our fixed overhead. We take away our fixed selling and admin expenses. That's 800,000. And look at that. Just what I told you. Net income was going to be 580,000 under variable costing. Let's move to a year, though, in which we produce more than we sell. In 2014, if you recall, we produced 60,000 units, but we only sell 40,000 units, leaving 20,000 in inventory. This is the contribution margin report for 13. Just more graphics to show you some different things. Again, if the units produced equal units sold, we end up with the exact same thing, so there is no cost difference between absorption and variable costing. Our total costs are exactly the same, 1.5 million. All right, here's 2014. The units produced exceed the units sold. We're going to produce 60 but only sell 40. This is variable costing now, right? When we're taking the variable cost out to get to contribution margin, We sold 40,000 units, gives us 1.6 million. 40,000 unit at the variable costing model, $680,000, giving us a contribution margin of 920. But our fixed expenses, 800,000, that doesn't change. Tells us our net income's 120,000. Okay, so let's now take a look at the absorption costing model. 40,000 is what we sold for 1.6, but cost of goods sold has to go in at $25 a unit. That's $1 million. Gross margin is 600,000, and our selling and administrative expenses are 280,000. Our net income is 320,000. Wow, that's a little bit crazy, because if you recall, under the variable costing, it was only 120,000, right? So let's see if we can see what happens. Under absorption costing, the 200,000 of fixed overhead was allocated to ending inventory and not expensed. Here it was expensed. Under variable costing, that 20,000 units at $10 per unit, if we go back quite a few slides, fixed overhead came down to $10 per unit. It's the difference between the $25 a unit under absorption costing and the $15 per unit in variable costing. That $10 in variable costing is locked up right here in fixed overhead, and we're able to expense it. But under absorption costing, it's under cost of goods sold, and that $10 gets hidden in inventory. That seems kind of like a crazy concept. Let's see if we can see it here. Here's absorption costing. Under absorption costing, we have to recognize that 40,000 times 10, right? And so what happens is our total costs are $1 million. What's happening here? We're not accounting for 20,000 units sitting in inventory. So our costs seem to be lower under absorption costing, but under variable, we leave this $10 at 40,000 units. We actually expense it all out. See here, fixed overhead's only expensed at 400,000, and under variable costing, fixed overhead, the whole thing, because it's considered a period cost, the whole thing gets expensed at 600,000, making our cost higher. If costs are higher, net income is lower, right? If costs are higher, net income is going to be lower. All right, so when units produced are less than units sold, then obviously we're going to get a very different picture. So net income, here it is. This is 2015. We've gone past 2014. We're now at 2015. We're selling 80,000 when we only produce 60. 3.2 million, cost of goods sold are 2 million. It's showing us a net income of 840,000. What happens under variable costing? I get a net income much higher. So when units produced are less than units sold, under variable costing, I'm typically going to have a higher net income. Did you see what the difference was? The difference between these two? I'm going to go back one slide. 840,000 for absorption, 1,040,000 for variable. Isn't that 200,000? But it's 200,000 the other way. In 2014,000, we also had a $200,000 difference. Here it is. Absorption costing gives us total cost of 2 million. Variable costing gives us 1.8 million. That's $200,000 cost difference. So in time, from 2013-14 to 15, really we netted out a zero difference, because it all ends up working out in the end, folks. No matter what, the numbers are still the numbers, and it still works out in the end. But we had this 1 year where things just kind of looked dramatically different between those two, but then it worked itself out the next year. While we had a $200,000 income disfavor in 2014, we had a favorable outcome in 2015 under variable costing. So it's still all worked out. But we probably have to get down to some point the why. Don't ever forget, why are we doing this? Why is this going crazy? What I'll tell you here, though, is that this income under variable costing has to be restated to get to absorption costing. Why is that? You don't want to run two sets of books for this, right? If we're going to be performing variable costing on a regular basis, because we need to use it to evaluate something that we haven't discussed yet, at some point you're going to have to convert that variable cost number over to absorption costing. The reason is because generally accepted accounting principles for your financial statements and for the IRS want you to use absorption costing. So if you use variable costing normally, you've got to get it back over to absorption costing. It's really not all that hard, it just feels a little bit different. So if we want to find income under absorption costing by converting away from variable, we take our income under variable, we add the fixed overhead costs in our ending inventory, and then we take away the beginning. I'm sure they're going to give us an example. Here it is, right? Remember, 2014 was the year that we had some kind of difference. We didn't have to worry about 2013, right? But definitely in 2014, and then we had to get 15 back as well. To restate it, remember, we've got to add back fixed overhead costs deferred. Let's see, well, it's not going to show us, but we'll see it in a group work, I promise. All right, so why do we do it? How can absorption costing create too much inventory or create too much or force us to basically produce too much inventory? First thing I want to tell you is that when we produce too much inventory, obviously we get excess inventory, we get higher storage and financing costs for that inventory, and we get a greater risk of obsolescence. You never, ever, ever want inventory sitting around on a shelf collecting dust. It's just bad news all the way around. You don't want it to happen. Stuff goes obsolete. You've got to get rid of it. It's going to cost you more in the long run. But if you produce too little, you're going to lose sales because customers are not going to be satisfied, right? You're not able to give them the inventory that they demand. So income under absorption costing for different levels of production. This graph cracks me up. This is probably the funniest graphic I've ever seen in any of the McGraw-Hill slides. Okay, let's just go through this and I'll tell you why it's funny. This guy on the left, he says, why is income under absorption costing affected by a production level when that for variable costing is not? The guy sitting at the computer, which I'm going to assume is the accountant here, right, gives him this nice simple answer. The answer lies in the different treatment of fixed overhead costs within the two methods. And then all of a sudden, this dude over here on the left, he completely understands it, right? He says, so under absorption costing, if excess units are produced, the fixed overhead cost allocated to those units is not expensed until a future period when those units are sold. And then the accountant says, exactly. Right. It just doesn't work that way, right? Even at this point, we're 29 slides in down here, folks, and I guarantee you probably don't exactly understand this yet, without a doubt. But what's happening here? Here's the thing. The fixed overhead cost that gets stuck in those units, that $10 per unit that made up the $200,000 under one method, it gets stuck in inventory, and it's really as simple as that. That's kind of hard to grasp conceptually until you start to work with the numbers. But it gets stuck in inventory. What happens when it's stuck in inventory? If it's in inventory, it's not being expensed. And if it's not being expensed, your net income is going to be higher. And if it's not in inventory, it's in cost of goods sold. Well, cost of goods sold is an expense, and that's going to make net income lower. That's really what this is all about. We can talk about it until we're blue in the face, and we can look at these slides until we're absolutely probably purple in the face, and we really might not get it until we start to work with it. All right, so again, under planning production, and here's where we start to understand the why. And I'm just going to tell you before it gets into it, is that just think about the fact that a production manager, somebody who is in charge of the factory, probably gets an incentive bonus on the net profit of the company, right? I mean, most managers of companies usually get a bonus that is dependent on how much profit they help the company to earn. Same thing with CEOs, CFOs, chief operating officers. All of them are going to get a bonus on what the bottom line of the company looks like. Well, here's what I'm going to tell you is that if you have a really, really savvy manager and he gets that you don't understand the difference between absorption costing and variable costing, then he's going to play the game under absorption costing. I would tell you that most companies that don't look at variable costing or don't have the know-how to work with variable costing, And of course, they have to do variable costing for pricing. I mean, there's no question about that. But if they don't know how to do variable costing, then they're really not evaluating their production management appropriately. Because, and here's the thing, all the production manager has to do is produce too much inventory. And by producing too much inventory, he can make net income look bigger. And that's what feels weird. By producing too much, he can make net income look bigger. And when net income is bigger, he gets a larger bonus. But what happens again when you produce too much inventory? It sits on the shelf and collects dust and really doesn't get sold. And that's what's really tricky to think about. So let's see if we can see what's going on. So here's under absorption costing when 60,000 units are produced, okay? Total production cost is $25 per unit, right? The higher the cost, the lower the net income, right? The higher the cost, the lower the net income when 60,000 units are produced. But look at what happens when 100,000 units are produced. Under absorption costing, production cost is only $21. Wait, the higher the production cost, the lower the net income. The lower the production cost, the higher the net income. This is the lower production cost. It's going to make a higher net income, and all we did was produce 40,000 more units. Why is this? I mean, it seems controverted, right? Well, when you produce 60,000 units, your fixed overhead cost per unit is $10, right? We take 600,000 of overhead costs divided by 60,000 units. But when we produce 100,000 units, remember, fixed overhead never changes. It's still 600,000, but when we divide it by 100,000 units, that's only $6 per unit. If you went back to last chapter and you looked at that graph that showed the fixed cost per unit, and I gave you the example of an unlimited telephone bill, right? If I pay $400 a month for my telephone, the first call I make is $400. But if I make 2 calls, each is worth $200. And it keeps going down, 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 right? The graph kind of made this weird curve that went down this way. And that's what's happening. The more I actually produce under that same cost, the lower the cost per unit's going to be. And when you start to look at production this way, it drives that production cost per unit down, and it really skews cost of goods sold, making the net income go up, right? And that's what's kind of weird. I just told you this, so I'm just going to go ahead and flip through it. So the 40,000 extra units would be stored in inventory, but production cost per unit becomes $4 less. Here it is. The income statement under absorption costing is 580,000, right? Full costing, right? And then this is at 60,000 units produced, but 60,000 units sold. So if we actually sold what we produced, this is real. This is our net income. But if we produced 100,000 units and still only sold 60, meaning we stuck 40 over in inventory, it's going to make the income look like 820,000. What are you talking about? We still only sold 60,000 units. This is fake income. It's not real under absorption costing. All that money is stuck in inventory. Guess what? If your production manager knows this little trick and the people in upper management don't realize it, you're going to bonus him on $820,000. And all he did was stick these extra 40,000 units in inventory, and you're holding the bag for it, right? Because if I were him, I'd take my bonus and I'd quit, right? Quit before somebody figures it out. All right. So on this one, again, so 60,000 units produced, 60,000 units sold, 580,000. This is under variable cost. This is under variable costing. 60,000 units produced, 60,000 units sold. Again, it never makes a difference under variable costing to absorption when they're equal. But now under variable costing, 100,000 units produced and 60,000 units sold, when you do it under variable, you get the exact same number, which is why you want to use variable costing to evaluate management's production performance, and that's why we do it. Wouldn't it have been nice to have a slide at the very beginning to say why we do it? It made you kind of go through the whole thing not knowing exactly what happens. But this is why we use variable costing in order to do performance evaluation for our management, because now he can't hide 40,000 units over an inventory, because we're going to see what it is no matter what. And the reason is right in here, because we're dealing with our cost of goods sold, right? We're getting it out the right way. So here's the production manager. He's like, oh man, he didn't help us out at all, right? It doesn't matter. Even if I produce more units, it doesn't affect the reported net income. And he actually has to sell units to increase net income. And you're daggone right. That's how it should be. If you want to make money, you got to sell them. All right, of course we're going to determine the selling price based on absorption costing. I've already said this without a doubt, although many factors impact pricing. Cost is a crucial factor, and we've got to include all costs, no matter what, in order to sell, and that just makes sense. So you're not going to use variable costing to set your prices. No question about that. You've got to set them with some very good estimates and some very good judgment. I think you all already know how to set prices. Maybe you don't, but we'll go through it. It says it's a three-step process, and again, I think we all kind of do it in our head. You determine the product cost per unit using absorption costing, and that means you're going to consider everything, figure out what your markup is, and then you're going to add that markup into the product cost. So let's just say it this way. You can kind of think through this on your own. If I have an item that under absorption costing cost me a total of $10, right? That's my cost per unit is $10. If I want a 100% markup, how much am I going to sell it for? And if you guess $20, you're absolutely right. If I mark a $10 cost up 100%, I'm just going to add it back to itself. Another $10 makes me sell it for $20. If I'm going to mark it up 50%, I would have marked it up $5, half of its cost, and I would sell it for $15. So that's exactly what's happening here. So if I'm doing absorption costing is $25 a unit, and my target markup per unit is going to be 60%, I'm going to add $15 to it and sell it for $40. Start with product cost. All right. And last but certainly not least, we're going to talk about controllable versus uncontrollable cost. Again, the why do we deal with absorption versus variable. Managers are responsible for controllable cost only. We should never be evaluating them on the things that they cannot control. By the way, that fixed production cost that we're going to make a period expense is the uncontrollable stuff. They don't have any bearing. The managers really don't have any bearing on those period fixed costs. So we shouldn't be considering them when we're evaluating their performance. Such as the manager's own salary is really kind of a perfect example in this, is that he can't control his own salary. He can't control his production capacity. He or she probably can't control how much rent you pay on the facility or what the electricity is. So therefore you need to strip those things out and do it under variable costing in order to evaluate your manager's performance. Realities that contribute to the widespread use of absorption costing by companies. Here are limitations of reports using variable costing. I'm going to tell you that limitations of reports using variable costing is management itself. Management doesn't always want you to use variable costing because they want to cheat the system and they want to get a good bonus, and they're going to just try to keep throwing stuff in inventory, and it's a shame. You need good accountants in these situations to try to basically go in and show management that, hey, this is wrong and this is why. So you've taken my class, now you know you'd be the good accountant for those companies. Realities that contribute to the widespread use. For income tax purposes, you must use absorption costing. Therefore, a lot of smaller companies don't bother with variable costing, and that's a shame because they're really not evaluating their companies appropriately. Not only that, but absorption costing is the only acceptable basis for reporting under GAAP and under international financial reporting standards. So we've got to run both. Most companies who do variable costing run their books under variable and then convert to absorption costing using that formula that we used a little while ago. And then the other limitation, which I think is not last but first, is that top executives are awarded bonuses based on income computed using absorption costing. Therefore, they want to use absorption to make that income look higher by producing too much inventory. Can you use it in pricing special orders? Absolutely, but just remember you've got to make the price high enough to cover all costs, including variable cost and fixed cost. And we're going to look, when we get into the chapter on decision analysis, I believe it's chapter 23, we're going to look at this a little bit more when we deal with setting prices using variable costing and fixed costing. So I don't want to spend a whole lot of time on it here. Don't worry about it much for this chapter because we'll be dealing it especially on the decision analysis for special orders later. So don't spend too much time on it in this one. And that is the end of chapter 19.